Hello friends, welcome back. So today we are going to discuss about inventory accounting, which include inventory valuation, cost flow and impairment. Suppose, let's start with the business case. Suppose you are working in a company. Suddenly the supply chain management informed you that there will be a sudden tech shift of 500,000 worth of smartphone component in the warehouse. Now that's are obsolete. That means you are an obsolescence loss. Obsolescence loss mean you already have a 500,000 worth of material in stock, but now it is shift from that technology to another technology. So that's a loss for you. So how you are going to account that loss? It's a big amount, and how you are reflecting, how you can reflect that loss in your profit and loss account or in your cost. At the same time, you are noticing that there is a sudden increase in the raw material cost. So if there is an increase in the raw material cost, definitely there will be an impact on the gross profit and company's tax liabilities also. So you have to assess how this material price impact is going to affect the tax liability, your cash outflow. So inventory management is one of the crucial point in the financial management and in the working capital management. Again, if you are looking into a company's balance sheet, if you list out your total current assets, there will be a big chance to have a major portion of the current assets will be inventory. Especially if you are in a trading company or in a manufacturing company. So it is very crucial to manage the inventory very effectively and very strategically to improve the business performance and to have a better tax advantage and to comply with the regulatory or reporting requirements. So before going into details, just start with what is an inventory. Inventory is the largest current asset in the balance sheet. Its valuation directly affects the income statement and the balance sheet. How it is going to affect the income statement? Via cost of goods sold. Cost of goods sold, the key component of your cost of goods sold is your inventory cost. So how you are valuing inventory is directly going to affect in the cost of goods sold. Then the balance sheet, how it is affecting in the balance sheet? Well, ending inventory, your ending inventory value will be reported in the balance sheet. So how you are valuing your inventory is directly affecting the income statement and balance sheet as well. The goal of inventory reporting is to match against the cost has to be matched against the revenue they generate, ensuring that the financial statement reflect economic reality of the business. The financial statement actually should reflect the economic reality of the business. So the goal of proper inventory reporting is to match the cost against the revenue. So let's move into some thinking. If the prices are rising, which method make our bottom line look better to investors? Suppose there is an inflationary environment, that means your raw material price is increasing. That means if you are buying, the new purchase will be with a new price. So the old material you can buy with a $10, then it come to 11, then it come to 13. So this is the fluctuation, or this is a movement in the inventory raw material price. You want to show a better bottom line to investors. Which inventory valuation method you can use? As you know, there are three key inventory valuation method. FIFO, that means first in first out, then LIFO, last in first out, then the weighted average. So in this case you have to use FIFO. FIFO means you are assuming that you are consuming the first purchased material first. That means first in first out. So if you are using FIFO, your cost will be $10 only. So that will give you more profit or better bottom line in your financial reports. The next thing, if you write down inventory because of it's damaged, does it count as an operating expense or loss? Suppose you have to write off some inventory due to damage. How you are going to reflect that in your financial statements? You cannot report as a cost. It should be reported as a periodic loss in the profit and loss account. Why would a company choose a method that result lower reported profit? Normally, companies are preferring to choose a accounting method which will report lower profit. What is the reason for that? The first thing is to have an advantage over the tax liability. If you are report more profit, you have to pay more liability. If you are reporting only less profit, you have to pay only less tax liability. So this is one reason that companies normally prefer to choose the method that reporting lower profit. So let's move into inventory valuation. How you are going to value an inventory? Inventory normally valuing or reporting in its cost, its total cost. Total cost means its purchase price plus the freight in. Is there any freight in that incurred to bring that material into your warehouse? That's your freight in. Then the insurance during transit. Is there you incurred an insurance tax during the transit? That is also you have to affect. Then the handling and storage charge. These are the costs you have to consider while valuing the inventory. First thing is the purchase price, then the freight, then the insurance and the handling and storage. Then the cost flow assumptions. Cost flow assumption we just discussed before. There are 3 key assumptions are there. First thing, first in first out, last in first out and weighted average method. What is first in first out? First in first out you assume that the oldest units are consuming or sold first. Ending inventory. So in the first in first out method, the oldest inventory are going to reflect in the cost of goods sold and the ending inventory in the and the latest purchase in the ending inventory. Then the LIFO. LIFO means last in first out. In the last in first out you assume that the new units are sold first. In the last in first out, you are considering your beginning stock, beginning purchase as your ending inventory and your last purchase as your cost of goods sold. Then the weighted average. Weighted average method means is total cost of spreading available for across all units. That means you are calculating your cost by averaging out your existing price plus your new purchase price. So in the first in first out method is normally using by company and weighted average method. These are the 2 methods normally companies are using to value their inventory because it's matching with business reality in most cases. Then the impairment of inventory. Inventory must be checked for impairment if its value drops below its cost. Suppose you purchased some material for 1 lakh rupees or $1 lakh, and if you are looking into and you purchased it in the beginning of the year, at the end of the year you realized that the current market value of this material is only 90,000. So in this case what you have to do? You have to do an impairment. Impairment means your value has to be, you have to reverse your inventory value to match with the business reality. So the inventory valuation method, 2 principles are there: lower of cost or net realizable value. If you are using FIFO method, in your FIFO method and weighted average, then you have to impair your stock value based on the lower of cost or net realizable value. So in this case you can see that this is your cost and this is your net realizable value. So in this case the lower you have to consider as your inventory value. So in this case it is 90,000 only you can consider as your inventory value in this case. Then the second method is lower of cost or market. It is mainly used in FIFO. Suppose your cost is the same 100,000 and the market price of that current market price is 90,000 only. So, in this case same you can take only 90,000 as your inventory value. So, this is what we call the impairment of inventory. Impairment of inventory means you are revaluing your inventory, you are comparing the inventory cost with your net realizable value or your market price. So, let us move into some corporate scenarios. A construction firm faces 15% increase in steel price. If they use LIFO, their cost of goods sold will be higher, because as we discussed they are considering their cost of goods sold, their last purchase they are considering as their cost of goods sold. So, if there is an inflationary environment, the cost of goods sold will be higher. That means they are using expensive new steel cost as cost of goods sold, which lead them to pay low taxable income, saving the company's cash on tax, even though on paper they look less profitable. So, in this company, if they are using LIFO method, last in first out method, they might have a big cost of goods sold and they report a lower gross profit or lower profit. So, this will help the company to save their tax liability, because if you are generating low profit, then you have to pay only lower level of tax. So, let us move into second scenario. A clothing retailer has 100,000 in winter cost at cost. By spring they cannot be sold only 60,000 after shipping cost. So, in this case what you have to do, you have to immediately report a loss of 40,000 due to prevent overstating your asset. So, in this case you have to consider only lower of cost or net realizable value as your stock price. So, the total cost is 100,000, but if you are looking to the net realizable value, it is only 60,000. So, as an inventory value you have to consider only the lowest of your cost or net realizable value. Which one is lower, that only you have to consider as your cost or your inventory value. So, here is a comparison between FIFO and LIFO method when it comes to inventory valuation. So, in an inflation environment, inflation means the rising prices. If the prices are rising, in the FIFO method, if you are using FIFO method, your cost of goods sold will be lower. Why? Because you are considering old stock as your cost of goods sold. So, it will be lower than the higher net income. Obviously, if your cost of goods sold is lower, your net income will be higher. Then the LIFO method. In the LIFO method, in the inflationary environment, there will be higher cost of goods sold, because you are using the latest purchase as your cost of goods sold. So, at the same time you are reporting a lower net income also, because if the cost of goods sold is higher, obviously your net income will be lower. Then the ending inventory. Ending inventory, the value are close to current replacement cost. If you are using FIFO, that means your ending inventory reflect your latest purchase, which reflect the current replacement cost. When it comes to LIFO, the ending inventory values are old cost. You are considering your ending inventory as your old purchase or your old cost. Then in the inflationary environment, the tax impact will be higher in FIFO, because your reported income will be or net income will be higher in FIFO. So, that is why you have to pay more tax. Again, when it comes to LIFO, you have to pay only low tax when it comes to an inflationary environment. Why? Because you have a higher cost of goods sold and your net profit will be lower. So, that is why you have to pay a low tax. Then the measurement rule, how you are measuring, how you are impairing your inventory. In the FIFO, it is lower of cost or net realizable value. Again, when it comes to LIFO, it is lower of cost or market price. This is how you are valuing your inventory. Then just a formula for lower of cost or net realizable value. What is net realizable value? Your estimated selling price of the material minus the cost you are expecting to complete that sales, that is your net realizable value. If your cost is greater than net realizable value, then you have to write down your inventory to net realizable value. So, when it comes to inventory valuation, you have to consider only the lower of net realizable value or cost, your cost. You have to compare your cost with your net realizable value or your market price, and you have to take only the lowest. If the cost is lower, then you have to consider only the cost as your inventory value. If the net realizable value or market value is lower, then you have to take your net realizable value or market value as your inventory value. So, is there any difference or is there any losses there in this process? Suppose your cost is 100,000 and your net realizable value is 90,000. So, there is a 10,000 loss. This 10,000 loss you have to immediately report as your inventory valuation loss in your profit and loss account. So, here are some important things you have to consider in the examination. Under US tax law, if company use LIFO for tax purpose, they must also use LIFO for financial reporting. So, the company cannot use one inventory valuation for tax purpose and one inventory valuation for their reporting purpose. It should be uniform, it should be same. If they are using a specific inventory valuation for the tax purpose, they have to use the same method for the financial reporting purpose also. Then the periodic versus perpetual inventory system. Perpetual inventory system update your stock or inventory after every sales or every purchase or every movement. Then the periodic inventory system update only after a physical stock at the end of the period. Perpetual means it is reflecting the inventory movement or inventory value, it reversing its inventory value after every single movement, whether it is in or out. In mean if you bought some material, it is in, and if you sell or if you issue some material, that is your outbound. In the perpetual inventory system, the system will review or it reverse or reflect the inventory cost after every inventory movement. When it comes to periodic system, it is reflecting only after a specific period. Then the freight out. What is freight out? Freight out means you are selling cost to your customer. This is not a part of your inventory cost, it is a selling expense. The freight in mean, is there any cost you include to bring that purchased material to your warehouse? That is your inventory cost. Is there any cost include to freight out cost? That means your customer shipping cost, that is not a part of your inventory cost, that is your selling expense. So, just a quick summary what we discussed today. Inventory cost include everything to get product sales ready. That means you have to consider your purchase cost, freight in, your insurance, your handling cost, everything you have to consider as inventory cost. Then the key inventory valuation method, FIFO method and LIFO method. Then the inventory impairment method, lower of cost or net realizable value. It is ensure that balance sheet is not bloated with overvalued goods. Then if you made any inventory mistake in the previous year, that would have a same impact in the opening following year's beginning inventory, because if you have an inventory closing inventory, suppose in 2024 you have a closing inventory of 1 million, what you will do, you are directly transferring this into your opening balance in 2025. So, if you have any mistake in this inventory, it is going to directly impact in the opening inventory of next period. So, let us move into multiple choice practice. A company using FIFO method has inventory with historical cost 50,000. The current replacement cost is 45,000. The estimated selling price is 52,000 and the estimated cost to sell is 5,000. At what value should the inventory be reported on the balance sheet? So, here you have to calculate your total cost and your net realizable value. Which one is lower, that will be your inventory value. So, the cost is already given here, it is 50,000. Now, you have to calculate your net realizable value. How you can calculate the net realizable value? What is net realizable value? Your selling price minus your estimated cost to sell, that is your net realizable value. So, your selling price is given 52,000 minus 5,000. So, it is 47,000, it is your net realizable value. So, here the lowest one is 47,000. So, in this case you can take only 47,000 as your inventory value, because the inventory impairment or inventory valuation, we have to consider only lower of inventory cost or net realizable value. So, in this case it is option B, 47,000. So, let us move into question number 2. During a period of consistent falling prices, deflation, which inventory cost flow assumption will result higher reported net income? So, if there is an deflation environment, deflation means the prices are falling down. So, in this environment or in this case, which inventory cost assumption will give you highest reported net income? Option A, FIFO method, option B, LIFO method, option C, weighted average, and option D, specific identification. So, which inventory valuation method will give you highest reported income? If you are using FIFO, what will happen in the deflationary environment? You are consuming the old stock. The old stock means it with the highest value. So, which will report a lowest net income in your books of account. If you are using LIFO means the last purchased item, that means the lowest cost item you are going to reflect in your cost of goods sold. So, how it will impact? It will report a higher net income in your profit and loss account. So, option B is the right answer here. You can see the explanation here. That means the last in the LIFO item is there in the deflationary environment, the last purchased item is the cheapest item. If you are consuming the last purchased item first, so definitely your net income will be higher, your cost of goods sold will be lower and your net income will be higher. So, option B is the right answer here. So, today we discussed about the inventory valuation. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.